call the Deferred Comp Advisory Committee meeting to order. Roll call, please.
Ms. Goodman?
Here.
Mr. Whelan?
Here.
Ms. Herman?
Here.
Mr. Hopkins?
Here.
Mr. Keokum?
Present.
Mr. Gardia?
Present.
Ms. Regalo?
Here.
And Mr. Woolcamp will not be with us today, so the record will show him absent. Thank you.
Thank you. And next we have public comment on the agenda. Any public comment?
We do not have any public comment.
Thank you. All right, then we'll move to Nationwide, Mr. Sagal, and the program status report for first quarter.
Thank you, and good morning. Happy to be here today. So we'll start, we have our report, looks like this. And so both Brenda and I will be presenting. I'll provide the statistics, and then Brenda will provide a field update, and we'll talk about what's happening here locally. So we'll start out on page 2 is your plan summary. And the top row is where the quarter started way back on January 1st. And then we have your 457 and your 401A plan. And so we list out all of your contributions, less distributions, subtract fees, add in loans, also add in other activity, and then the gain-loss row is the market fluctuation for the quarter. So on the far right column, the plan in general lost $9.2 million due to market fluctuation. So the quarter started at $573 million, ended at $597 million. There has been a lot of fluctuation, as we know, since, but your plan is actually back to where it was over the past couple of months. So we've had a pretty good gain. Moving on to, I'll skip ahead to page 6. We won't go over every single detail, but page 6 discusses participation in your plan. And on the upper left of page 6, we have the participants with a balance total. So at the end of the first quarter, 7,553 participants were in the 457 plan. Again, this is just your 457 plan, and then we have some pages for your 401A. Your average balance right below that, $75,000 per participant. That's down slightly from the quarter prior due to market fluctuation. And then on the right-hand side at the bottom is Roth usage. So Roth is the after-tax money that your participants can choose to invest in. And we have 1,290 participants that have elected Roth at just over $10 million in assets. And then finally, that wheel on the bottom of the page, this shows asset status by employment. So 52% of the assets in your plan are held by participants who still work for the county. And then 46% of the assets are held by those folks who are no longer with the county. But all participants can still utilize our services as well as Brenda. So if they ever want to come in and see us, they're more than welcome to. On page 7, we already talked about Roth. The other section on the page is the bottom, and that's self-directed brokerage. I won't go through it today, but we also have a Schwab quarterly report that Schwab sends to us to provide to you as the committee. And Schwab will list out all of the various holdings, not all, but the top 10 holdings, whether it's mutual funds, stocks, fixed income, ETFs, et cetera. And so there are about $2 million in assets in Schwab with a $167,000 average balance. So again, as a reminder, your participants, if they want to invest outside of the core options, they can. They simply enroll through Schwab, and then they use Nationwide as sort of a conduit to move money into Schwab, where it goes into a sweep account, and then they trade. And at some point, they'll have to sell off their holdings, move it back to Nationwide to take their money out of the plan at some point down the road. Moving on to page 8, contributions. Right in the middle of the page, we have current quarter. So this is money in that we received over the first quarter, again, from January to March 31st. We received $10.6 million from your participants. You can see the various items that are listed out, the top row being salary contributions. So $7.3 million of that is payroll deferrals that we received. We did have some account splits, some rollovers and transfers in, and looks like some employer contributions to make up the number. And then on the far right-hand column on the bottom, we have listed by asset class. So when Nationwide receives contributions from your participants, 52% of every dollar we receive goes into a target date fund. Less than 5% goes into a bond fund. You can see fixed assets / cash, so something secure where there's no market risk. And then the rest of those contributions are going to either stock or bond mutual funds or target date funds. Then on the next page, distribution. So we talk about money in, so money out. So again, that current quarter, right in the middle of the page, 11.7 million is went out the door in the first quarter. You can see the very top row is rollovers and transfers. So 5.2, about little less than half rolled out of the plan. We have the top 5 companies where it's going to at the bottom of the page. Then we also had some retirement payouts, which we always do, and then the other various forms of money out throughout your plan for the quarter. But again, it's about 50-50. About half goes out to rollovers, the other half goes out to just folks taking contributions in cash. So any questions about money in or money out from the plan? It's pretty consistent with quarters prior. Assets on page 10, the only item I'm going to talk about is the upper left, and this is also in the highest report. The assets, you can see we looked at contributions or future money, where it's going. Well, assets, this is where current money is sitting in your plan. So the target date funds represent about 23% of assets, total assets within your 457. And then the other large areas are fixed assets and cash, or 24%, and then large cap stock mutual funds have about a third of the money inside the 457. And then the next couple of pages, we list out every single investment option, and we list out the assets in each, and then we also list the total participants in each of the funds. That's always good. If there's ever a fund change necessary, then we'll know the impact on that. And so I'm not going to talk too much about pages 11 or 12, but I want to move to page 13, which is loan activity. Loan activity, there are $3 million in outstanding loan balances currently from participants who have already taken loans, and there's 352 outstanding loans currently. Last quarter, we paid out 32, and 29 were paid off. So you're pretty flat with respect to new loans. You're almost paying out as many, or we're almost paying out as many as are being closed. So not a lot to share. And then on the far upper right is the average loan balance in that little gray box. And so there's an average of $8,700 per loan. So you can borrow up to 50% of your account balance, not to exceed $50,000, and your participants are electing to borrow much less. So again, around $8,700 is the average loan. Any questions about loans? Again, fairly straightforward information. Pretty flat, not much activity. And then for your 457 on page 14, this is your enablement and engagement statistics. Right in the middle of the page, we measure things like e-delivery. So 72% of your participants have opted out of receiving paper communications from Nationwide. So they're not getting any more paper statements or any kind of fund change notifications. They can always opt out of that if they want. So that's always controlled through the app or through the website. So if they want to opt back in, they can. And then everything is stored on the website. So they don't necessarily really need to get paper. Online accounts, 66%. This number is rising and has been since we've been your vendor over the last about 2.5 years. So 66%, again, have an online account Nationwide. We measure online distributions, so how many people take a distribution through the computer versus a traditional form. 67% are taking withdrawals online. Then we jump up to the upper right. We have beneficiaries, 90%. We've discussed this in the past, so it's a pretty good number overall. We're not happy until we have 100%, but no plan is perfect, and we've never seen 100%, even though we'd like to. So this just means on file with us, not necessarily on file completely. So if we don't have it, then we'll come back to the county and just see if there's one sitting around. But 90%. It's also on quarterly statements too. So if we don't have your beneficiary, we'll let you know on your statement as a reminder. Emails, 91%. That's a really great number. So we're very happy with that. Online enrollment, they have the ability to enroll online. About 27% of applications are done that way. The rest are done through forms. And then wrapping up with the bottom row, this is My Investment Planner is free online investment advice. And Retirement Planner is the software program we have to create a retirement readiness score for your participants. So by answering some questions, their score gets improved as they go through the software. So we recommend that to everyone. You can put your pension, your outside assets, and et cetera. And then I'm going to wrap up on page 16, just a snapshot of your 401A plan. Actually, page 16 and 17. So page 16 is, again, the balance sheet that we've already seen from page 2. Page 17 is just the overview page, and it has all of your 401A data that's just on one page. So it has your total asset balance of 32 million, 145 participants, very high average balance, as you can see, over 200,000. And then the money in versus money out, and then some rollover out that we also saw for the first quarter. So I'm going to pause and see if there's any questions about any of the data that you've seen. But overall, pretty volatile quarter, as we saw with that parenthesis in the market loss. So we went almost the entire run with Nationwide without seeing a market loss, but those things happen. But any questions or comments about the data in
John,
Nationwide stats?
Ponce, a quick question regarding the participants. I know you said it was you have a 90% participation rate. So if someone invests $50 5 years ago and they didn't invest anything ever since, are they still considered a participant, or do they cut off after a while?
Yeah, so any account balance is an active participant.
Okay.
And I did want to share a little bit surrounding the beneficiary. The county did an amazing job when Nationwide came on board, working with the pension system, and HR drove this to get meetings with all of your active employees to bring them up to date on their beneficiaries. Whenever I sit down with somebody, I do what I call housekeeping. We check their contact information, we check their beneficiaries. So that's an ongoing effort. And in the rare occasion, and there has been some since Nationwide has taken over, at least one that I know of, the county has done a fantastic job keeping all of the applications on file, on microfiche, on old computer system. So I know I can reach out to Lori and get whatever documents I need. So we have this covered here at the county in a really great way.
And then we also reach out each November, at least once a year, to make another request to anyone who doesn't have one on file. So that's part of our standard marketing is, again, that reach out.
Yeah, I just was on the website when I was at the sheriff's office yesterday, and one of the banners that came up on the website is you check your contact information, and then sometimes they'll change it to check your beneficiary information. And once in a while I catch, oh, I got a divorce, or I got married, and we just update the stuff. So that's an ongoing effort with our team.
Question on the 401As, the average plan participant balance is so much larger, and I know it's a, I believe, newer option, but it's interesting, it's a newer option with so much money in there. I just wonder if you see that characteristic of other plans, and if you have any comments on it.
Yes, so it's not characteristic of other plans. The 401A, the legacy on this was that years and years ago, the doctors at County General and certain nurses had it, they were not part of the pension. So instead, they were given this option. And the county kind of changed it a little bit once they became part of the pension system and started using it as an attraction and retention tool. So we've got highly compensated employees putting money in this space where that's not normally the case. Does
It's
that make
usually
sense?
about half of your 457 balance, kind of on average. So this is definitely a standout.
Yeah, good question. You want me to go into territory? Any other questions?
A quick question. So is there an incentive, so like e-delivery, does it save the company money? Obviously, if there's an e-delivery, is there a cost to mailing out, I imagine?
It's the same pricing regardless. And yes, it would save Nationwide money. It would just be postage and paper. And so there is a very small cost savings, but not enough to incentivize or anything like
Okay.
that.
That's
But we would prefer it. But there's people like my parents are never going to opt out of e-delivery. I mean, it's like my dad has a folder with, it's 3-hole punched and he has a binder. And so there are people who are never going to opt out. But there is a minor cost savings associated with it.
Right. Yeah, you answered my second question with the incentivize, so, perfect.
Yeah. Yeah, and it's not something that we push or advertise. I mean, once in a while, we can do a sweep where if a, plan requests that we sweep everyone in, we can do that. But typically in these large government plans, we don't do that.
To highlight the heightened level of security. I've had my mail stolen living here in Stockton. I've had my mail stolen living in Riverbank. So when you're not putting your personal information, your financial information through the mail, that's an additional layer of security for people. So when I'm talking to them and we tend to move toward the digital option. Any other questions for John?
Yeah, I have one question on page 14, the My Investment Planner. Is that some sort of a financial education tool?
Yeah, so I can talk about the investment planning tool. That is really a nice tool that we offer here at Nationwide that wasn't available with your former record keepers. And it's a kind of like a magazine quiz where you answer a few questions, you learn about your tolerance for risk, and if we get to the end and you agree, then we get guidance from our partners at Wilshire at no additional cost on how to create a custom portfolio. And I can explain to people custom portfolios can create higher earnings due to the additional compoundings. And then also it can be beneficial for people moving toward retirement because it gives them a choice on how they're going to spend down or deaccumulate their money and ways that it can last them longer in retirement. So I'm loving the tool. I use it at every opportunity to help people better understand their investment options and kind of give them that confidence to understand why they're investing the way they're investing.
Thank you. So I think the utilization is a little low. For this one, I see that only 21 participants. Can we run some sort of a campaign maybe this year just to promote this and people start using this?
Yeah, and the number shown is the number that used it that quarter, so we don't do a running total.
Okay.
Like we do with the one to the left of it, we do a running total of how many participants have used the software and have a retimer ready to score. We'll look into that to see. Yeah.
Thank you.
I would assume, but I'll double check that we do as part of our standard marketing efforts, but we'll definitely take a look.
That's a great idea.
Yeah, do a campaign.
May I ask a question? March is basically retirement month in San Joaquin County, so what I would expect the rollouts to be higher in March. And I know we've talked before about more outreach to people retiring, about not pulling their money out, because there are several financial institutions close to this building that actively reach out to our retirees about moving their money into different products that are housed elsewhere. So are we doing anything to do a better job or, reach out to our retirees, particularly, like I've said, March is retirement month. I mean, I don't remember the percentage, but it's more than 50% of retirees go out in March for the year.
Yeah, that's a great comment, Kathy. So part of what I do on an ongoing basis is I work with the county pension. They're a great partner. They've always been a great partner with the county, and we do the For Those About to Retire seminars. And so that's an opportunity for me to highlight that this is a lifetime benefit. So I do focus on that. And also as I'm meeting with people who are about to retire, we talk about it. And then that leads me to the campaign that we do quarterly. And so one of the options for classes that we offer is Nearing Retirement, where again, we talk about the fact that this is a lifetime benefit and that the fees and charges are lower. And we talk about all the benefits of staying in the plan and the fact that our retirees still have service. I talk to our retirees pretty consistently, and whenever they tell me what's on their mind, I try to bring that here. But we could probably work on some kind of a campaign. I'm aware of the March push for people and the cost of living.
Pep sounds about February.
What is that, benefits of?
Benefits staying in your plan.
Oh, okay, so John just mentioned we did a digital benefits of staying in your plan outreach to people in February, so that's, something, so we kind of try to give people different touch points, whether it's digital or in person. And I just actually met with the county pension system, because they're all members as well, and we kind of
Right,
had that
right.
conversation too. So,
So, I don't know if it's possible, but like a big, large sum of money comes out at retirement. That's when people mostly they pull the money. And somehow it'd be interesting to figure out the why. Is it fees? Is it service? Is it hands-on? Do you feel like you can walk in and see the person? I don't know the answer.
I have some
But that could be
idea.
interesting, a little bit of interesting market research.
Yeah. So I'll give you an example. I just had a young lady from the DA's office move to another county, and the first thing she did when she reached out to me was, let's enroll and let's move my other money. So the myth out there is that once you move from one employer to another, you have to do something with your money. So we're constantly trying to dispel that myth. And the conversation that I had with her led to us retaining here at this plan over $400,000 of her assets. So that is an ongoing push, just to educate people that they don't have to walk out the door with their money. And then in addition to that, I'm really looking forward to the opportunity. There's a Resco luncheon that I'm going to be participating in August. And so that will give me some in-person touch points with our retirees. So definitely that effort is top of mind.
Right, okay. Thanks.
One other comment, and we've talked about it and addressed it in previous meetings, is that the two characteristics that a retiree has, let's separate from service, or more importantly, the retirees, is they have relatively large balances and they have the ability to move. And so when we saw interest rates spike in 2022, it caused a split issue with the general account fund here in the county, but also outside a money market fund, where you were getting, say, 2.5% guaranteed here, or you could roll $300,000, $500,000 to a bank and get 5.25.
Right.
So there was that dynamic.
There's that, yeah.
Yeah, and then we added that money market fund to, in a way, address that rollout situation, not entirely, but that was one key aspect that people were chasing returns and they were allowed to do it.
Yeah, and CDs was the other ask, and in the committee, we updated the Schwab self-directed brokerage option to add some other options other than just mutual funds to, again, and I tell people that you have the option to do a CD, you can link it, the fees and charges are still lower with us versus moving. So that's definitely, we're working toward that retention
Oh,
piece.
sounds like it, thank you.
You bet. All right, so any other questions for John about the report? Okay, so I'm just gonna share kind of what's been happening in my world. A lot's been going on. We did have our seminars that my team and I do, and really San Joaquin County came out in force for these virtual presentations. We had 342 people for all 5 presentations, which is some of the highest participation I've seen. So kudos to the county for getting the word out to your employees through our partners with ITSD. We also did a separate market volatility webinar for our area, and we had 70 participants from the county take advantage of that sort of time-sensitive support that we can offer to help people understand what's happening and what their options are with their investments. So that's an ongoing thing. I've got some information I'm gonna get out to our team in HR about the upcoming webinar, because there definitely seems to be an appetite for education here at the county. So we definitely want to continue to support that. In addition to those virtual opportunities, of course, May is open enrollment, as it's always been for the county, and I was super excited to get the chance to come back in person and meet with people face to face. So we visited the hospital, which of course there was a fantastic barbecue we all got to take advantage of. And we had a lot of people come out for that in-person benefit fair, probably the highest number there. We had offerings here at the county admin building and then out up at Public Works. So lots of in-person conversations. I did a virtual presentation as part of the benefits opportunity. I had, not a lot of attendance for that, but then I also did in-person here in this building. And through all those conversations, it was a really great opportunity to get people set up with their online access. Talk a little bit about Retirement Income Builder. I have a little video I've shared with people on that to give them kind of a taste of what's coming. That conversation also helped to retain the over $400,000 that almost left. So that new investment that the county is adopting is already doing its job. So very excited about that. Also, I always try to do outreach to departments I haven't had the chance to visit with yet. And so in March, I got to visit adult and juvenile probation. So that was a great opportunity to meet with our public safety. And then in April, that was my opportunity. One of my friends from Lincoln High School, who was our math teacher, is now an employee over the county pension, Trent Kaislin. So it was fun to go over and see him and say hello and meet with the team there and really talk about the partnership and how much we can work together to really help people have their best retirement outcomes. And I shared with them kind of where I meet with them in terms of talking about purchasing service credit, especially during at the new employee orientation as I'm meeting people along the way, and those opportunities to boost the pension income. So lots of fun opportunities with the benefit fair to meet with people and do some little giveaways, and then lots of ongoing effort for education. Any questions about that?
I was just wondering what departments you're planning on visiting in the next few months.
Yeah, so it's so funny. I was writing that down last night. So while I was out at Public Works, I made contacts with their neighbors at Environmental Health. So I'm going to be visiting there next month. I've also finally found a connection into the DA's office. So I'll be there. I'm expanding my visits for public health. I found a connection at WIC. So I'll be going there and really looking forward to connecting with those new departments. Also, I am meeting, after this meeting, there are 2 therapy departments, one in Lodi and one in Tracy, and I connected with their manager, and they're being given the opportunity to do meetings with me today in Lathrop. So really, anytime I have an employee say, hey, we'd really like to see you, I ask them, where do you work? Who do I reach out to so that I can come and meet you where you are? So that's an ongoing effort, and I'm always excited when I get the chance to kind of, give that education and meet people where they are in the workplace.
And thank you for coming to the sheriff's office yesterday. We appreciate it.
Yes, I was busy, thank you. That was a fun day.
All right, well, Ms. Strange helped me realize that I skipped over a very important part of our agenda, the minutes. So if it's okay, we'll go back to that. So if I could get a motion to approve the minutes of February 27, 2025.
I will move to accept them. Kathy Herman.
Have a first.
Second.
First and second, all in favor, say aye.
Aye.
Opposed, no. Motion carries unanimously. Apologize for that. I was just in such a rush to get to the quarterly report. All right, anything else from Nationwide, or should we move on to the highest report? All right, Vincent.
Thank you very much. For those reading along, if you can pull out probably the thicker report, if you will. And on the cover is our firm name, Highest Group. In May of this year, we are formally announcing in an exciting but also sad way, our name is going to be changing. So a little bit of background. I worked for the Highest Group for over 10 years. We started as a boutique retirement plan consulting firm. And about 3 years ago, we were bought out by Morgan Stanley, the large multinational investment bank. Morgan Stanley committed that we would remain independent, boutique feel, and that pledge has been carried out. That was about 3 years ago. About a year ago, Morgan Stanley bought another boutique firm based out of Colorado called Cook Street Consulting. We were operating independently from each other, but also marrying resources. And finally, in this month, it was announced that we were merging firms. Cook Street and Highest Group will now be known as Fiduciary Consulting Group. So in a way, I'm sad that the Highest Group name will be retired, but because we have a deeper bench in terms of consultants and expertise, but also analytical horsepower in terms of research, very, very excited for the next chapter. The FCG, or Fiduciary Consulting Group, has pledged that the disruption to you as a client will be minimal in terms of invoicing, contract, personnel, staffing, that sort of thing. Very, very minimal. Maybe the look and feel of our reports might change a little bit, but other than that, disruption should be minimal, if non-existent. So questions, comments on that?
You're staying with us as far as you know?
As long as you'll have me, absolutely. Yes, thank you. Yes. Okay, let's get into the report. And I guess I'll title it, if not volatile markets, what a difference a quarter makes. If you remember in the last part of 2024, there were a lot of asset classes or indexes that spiked, some that didn't do so well, almost a complete reversal in the first quarter of 2025. I have data as of March 31st, and it seems like it's been a lifetime since the end of the first quarter, because a lot of the things that zigged in the first quarter have zagged, and vice versa. So let's go ahead, excuse me, and flip ahead to page 4 of the report. I'll skip over the text-heavy narrative and then just explain what we're seeing in the economy and the markets. Certainly, the two drivers of the headline post-election are this trade war or / tariffs. And John punched out eloquently in terms of the volatile nature, in terms of not only the impact or the threat of trade war or tariffs, but also job cuts, cuts to entitlement programs, cuts to grants. There's a lot of uncertainty. But nonetheless, as I talk about one of the economic indicators on page 4, upper left, gross domestic product. In the latter part of last year, we did settle into this Goldilocks economy, at least as measured by GDP or gross domestic product. And that chart on the upper left has 2 lines. You'll see the solid line, that is the dollar value of all the goods and services produced in the United States in any given year, and that corresponds to the left-hand vertical axis, hence the dollar signs. And the nice thing is you can see the depths of the pandemic in 2020. It went from bottom left to up and to the right. So there has been a nice expansion, but most economists focus on that lightly dotted line, and that's the year-over-year change. And when I talk about this soft landing or Goldilocks economy, they call it that because it's not too hot, not too cold, rather just right. And that's about a 2 to 3% growth rate in GDP, and that's exactly what we saw in the last part of last year. Then we moved into the first quarter, where since the first time since 2022, we actually saw a contraction or a negative GDP print. And so the advanced number recently came out at negative 0.3. It ticked up a little bit, but it's still negative. The second number is now 0.2% to the downside. Now, again, I mentioned this volatile nature or a lot of the uncertainty. We continue to spend, but we're pulling back. And we, being the American consumer, drives 2/3 of the economy. And back to my point about the uncertainty, depending on the survey that you read, the consumer confidence level is about a 5-year low. And so a lot of economists are now starting to talk about the R word, the recessionary environment. But nonetheless, taking a look back, the job numbers continue to do well. I'm now in the upper right, the unemployment rate. A measure of full employment is an unemployment rate of 5%. We haven't seen a number nationally that high in a number of years. It's settled down to about 3.5% for a period of time, but it is ticking up. The latest read nationally is 4.2%, so not even close to the 5% number, but it is weakening. Here locally in the county, it's a little bit higher at just over 6%. But again, generally, we're happy with our jobs. But again, more to come as these threats percolate through the system out of Washington, D.C. And then last but not least, one of the mandates of the Federal Reserve or the U.S. Central Bank is keeping a lid on inflation. So the chart on the bottom right, the Consumer Price Index, is one measure of inflation, and the target is 2%. We're now at 2.3%. Remember, In 2022, it was over 9%. So thanks to those interest rate hikes that I talked about, we have seen a dampening on this inflationary number. And so when we talk about this recessionary environment that may be coming, plus this mission accomplished, if you will, on inflation, we take a look at our cloudy crystal ball. In terms of rate movement in 2025, we are actually expecting 2 interest rate cuts expected in the marketplace, at least on the overnight side. So from a Federal Reserve standpoint, or at least the Fed fund rates, we do see 2 cuts priced in the market. But given a lot of things that we're seeing, we have seen the 10-year Treasury spike, driven in part due to the U.S. downgrade. I don't know if you saw, but the last of the 3 credit rating agencies downgraded our U.S. debt. And so we did see a spike in the 10-year Treasury here recently, and that leads us into the next page. As interest rates go up, the value of existing bonds go down. And so when we take a look at the bond market on page 5, upper left, second line down, you'll see the Bloomberg U.S. aggregate. If you remember in the fourth quarter of last year, that bond market lost 3% just in the fourth quarter. Take a look at the first quarter, positive 2.78%. Year to date, as of this week, 1.9%. So we have seen a little bit of slippage in the bond market, but still positive 2-ish% is pretty healthy, despite the fact that we did see a run-up in the yields on the longer end of the curve. And then if you flip ahead to the next page, page 6, I want to talk briefly about the U.S. stock market. This is what gets most of the headlines when people talk about the market or the markets. The upper, excuse me, the upper right, first line down, that's the S&P 500. These are 500 large U.S. companies, typically household names like Microsoft, Apple, Tesla, et cetera. In 2023, that index was up over 20%. Last year was up over 20%. Back to John's point about sometimes the markets don't cooperate. You could also maybe call that a reversion of the mean. You can see for the quarter, negative 4.3%. But thanks in large part due to these relaxing tariffs or these trade deals struck with the UK, with China, there has been a rally in the US stock market. So year to date, positive 0.7% as of this week. So huge swing in the US stock market. And then I talk about the US stock market on the next page, page 7. There are about 43 countries outside the US with an investable stock market. So think Poland, Brazil, China, Canada, Mexico. Those 40-ish countries are represented on the upper left, first line. The ACWI stands for All Country World Index, also known as the ACWI, ex-US, because we do strip out the United States. You can see for the first 3 months of this year, up 5.25%. Up 14% year to date as of this week. So huge run up. Again, I think it's testament to the administration going around the globe, striking these deals, or at least promising that they were going to engage to strike deals. Plus, this is driven by a weakening US dollar. Remember, in the fourth quarter, the US dollar spiked. We have seen a significant softening of the US dollar, especially with the Bank of Japan raising rates. And so that 14% print year to date is pretty impressive, but those are generally the causes of this run up in the international stock markets. So pretty impressive returns around the globe. I'll pause, take a breath. Questions, comments? Okay. Flip ahead to the next section, page 9. This is the somewhat high-level overview, some would say the executive summary. On page 9, just a couple things worthy of note. Towards the middle on the left-hand column, we do have some plan notes at the fund level. In the beginning of January, that Invesco Real Estate Fund was replaced by the DFA Real Estate Securities Fund. At a previous meeting, the target date models are moving from the mutual fund to the collective investment trust, and so that's in process. So more to come in terms of an effective date there. The next line under governance, way back in April of 2024, the investment policy statement was last adopted, and so we have that as an agenda item for this meeting. And then I already talked about the firm integration update. And now moving into the fund notes, bottom third of page 9, we do have 2 funds that are currently on watch and 1 fund, very much discomforting, but because of the newness of DFA, that DFA real estate, this is the third fund. This is the fund that was just replaced in the lineup. And so almost immediately, we added it, and then now we're placing it on watch. The good news is the near-term performance, or the performance that participants here in the county's plan have had, is pretty impressive, but more to come on that. But back to the top, MFS Midcap Growth. This is a fund that focuses on higher quality companies, and the short-term performance is pretty impressive. No real long-term issues, and we'll talk about that later in the report. The one fund that is giving us a little bit of discomfort is the Vanguard International Value. Not only is the near-term performance mediocre at best, but the style drift is significant. Meaning, if you read the name Vanguard International Value, it was hired, and you would think, or participants should think, that that fund invests in international value companies. The style drift is moving away from value, closer to growth. In other words, from a portfolio standpoint, this fund is overweight technology, underweight financials, and in talking to the 3 sub-advisors of this fund, moving back to value is not necessarily on their horizon. And so our recommendation is to bring a search document for possible replacements of Vanguard International Value at the next meeting.
Question on that? So how's it doing? I know it's not doing what it's supposed to be doing, but how are the returns looking on it?
Great question. Give me 3 to 4 minutes and I will, yeah, absolutely. That's a very logical question, but let me go through a couple pages before I get into the performance. Yeah, no. Other questions, comments? Okay, briefly, let's go into the next section, page 10. This is now the 457, obviously the much larger plan. On the bottom half of page 10, if you focus on the navy blue columns, this is the weighted performance of the investment options across the entire plan. You can see for the quarter, as John said about the market returns, negative 1.25% for the first 3-month period of this year. The nice thing is the 1 year is positive at 5.25%. Also about 5.5% annualized over 3 years, but even more impressively, almost 10% annualized over the last 5 years. So again, from an investment standpoint, maintaining that long perspective or that long view, despite some short-term volatility, as I talked about. And then on the next 2 pages, conveniently, just in your report, pages 11 and 12, this is the investment menu that the 457 participants can choose from to invest across the deferred comp program. What we do is on the left-hand column, all the investment options on the menu, we group them by asset class and then generally rank them in risk order. So you have the more conservative fixed income funds up top, the large, mid, small companies towards the middle of that page, the funds that invest in the international countries, and then the asset allocation, target date models managed by T. Rowe Price. These are the models that are going to be moving to the collective investment trust here pretty soon. And then on the middle or end of that page 12, the specialty funds. Again, the real estate fund was swapped out on January 10th, and then the Invesco Gold and Special Minerals rounding out that. And then the beginning balance, I now am on the columns, the cash flow, money going in, money leaving, any gain loss, the ending balance, and then rounding out that right-hand column, the allocation of the overall 457 portfolio. Again, that Vanguard Federal Money Market, now I'm on the top of page 11, that was added towards the end of 2023 in response mainly to the participants who were chasing yield, rightfully so. And you can see it's been in the plan for about 1.5 years, just over $7 million in that Vanguard Federal Money Market. And then towards the bottom of page 11 under International, the Fidelity International Index, that was added July of 2024, and you can see $700,000 allocated to that particular fund over the last few months. And then flip ahead to page 15. What we do is we track a lot of data points, and so I'll be brief. On page 15, towards the top half, or 2/3, you can see 2020, the fund or the plan was just under 500 million. It hit a relatively high watermark in 2021, just under 550 million. And then thanks to, mainly driven by a short-term spike in interest rates, where the bond market was off about 13%, the S&P 500 was off about 20%, dropped back down to about 465 million. But thanks to those market gains, you can see as of quarter end, $565 million. And then on the bottom third, second line down, this, to belabor the point, I'm sorry, but I think it bears calling out because this was a issue. We do track cash flow, the money going in and money coming out. In 2020, it was very slight, a loss, but a loss of only $363,000 until we move into 2021. The planned loss on a cash flow basis, almost 20 million, and then about half of that in 2022, 15.8 million in 23, about 10 million in 24, and then only $1 million in the first quarter. And so we have seen that trend reverse itself, but again, it was a significant problem, Kathy, to a lot of reasons you were talking about. And then briefly in the 401A, the next section, page 16, you can see the navy blue portion. This plan lost about 2.25% for the first 3-month period of 2025. The annualized number over 1 year is about 6%, about 6.5%, and then 12% annualized over 5 years. So a little bit more aggressive allocation, hence a slightly more volatile nature of the 401A program. And then on page 17 and 18, this should look familiar, same investment menu, obviously different asset levels and different asset allocation. And the other thing to keep in mind, towards the middle of page 18, bottom of the chart, you can see just under $82,000 in forfeitures, so just something to keep in mind. And then the planned growth of the 401A program looks a little bit different on page 21, from 22 million to 32 million over the last few years. And then if you go to page 24, I do want to highlight just the performance, and I'll go in order, but not forgetting your question. On page 24, this starts the performance section of all the investment options on the menus. Each blue row is a fund on the menus. And then as you move from left to right, there's performance net of the fee over different time periods. And so you can see the more recent quarter, and then you have 1, 3, 5, and 10 year. And then from center to right, you have the calendar year returns. Directly beneath each blue row is a performance of the underlying index or appropriate benchmark. But I think it's even more telling is the next line, plus or minus index. Anytime there's parentheses, that means the fund underperformed its relevant benchmark. If there's no parentheses, that connotes outperformance. And then the grayed out row, which the Nationwide Fixed Account does not have, but every other option has a peer group ranking in the grayed out row. And those peer group rankings is where Morningstar takes a look at all of the similar strategy funds, ranks them, and then these numbers are expressed as percentiles, where numbers closer to 1 are better than numbers closer to 100. And so you can see the performance, and this goes back to my point about the fixed account, which for the year is up 2.67%, but the money market is up almost 5%. And the point is made when you look at 2023 and 2024, where participants could earn a guaranteed 2.5% here in the plan, but in 2023, 5.1 and 5.2 in 2024. And again, that was a cause for partial rollouts of these retirees who were, again, rightfully so, chasing yield. But what goes up can generally come down. And so, again, maybe a short-term good decision with long-term consequences. Make sense? Okay. Flip ahead to page 25. This is where I was talking about that MFS mid-cap growth, conveniently at the bottom of page 25. This is the fund that's on watch, where I said the short-term numbers are very promising. Back in a couple years ago, this fund was mediocre, but if you take a look at the 10-year performance, the fund is up over 10%, beating the benchmark, and then you can see in the 13th percentile. meaning it is beating 87% of its peers over a 10-year period. But the number gets a little bit better over the short term. Better insofar as the fund lost 6%, but the index lost 7%. And so it beat the benchmark for the quarter by 1.1%, meaning it didn't lose as much. But you can see slipped in the peer group ranking from 13th over 10 years to 18th for the quarter. Again, talking to the management team at MFS, no long-term concerns, despite the fact that over 5 years, it is below median and is still a watch candidate, but our recommendation is to leave it in the plan. So now this is where we answer your question. On page 26, towards the middle of the page, that Vanguard International Value, which is the fourth blue line down, you can see the fund for the quarter was up 4.5%. The index was up 8.5%, so it lagged the benchmark by 4%. Can everyone see the ranking? Yeah. I'm glad you're laughing. That's a good sign. Nonetheless, the performance is not great. So the performance is one indicator of a broken down process, but in my career, I have seen good long-term managers suffer short-term bouts of weakness. But for the year, you can see 98th percentile, over 3 years, 92nd. And back to my point, when you pair the performance, or more to the point, underperformance, plus this style drift away from value to more growthy names, this is the reason why the style drift with no rectifying back to value, plus it's going to take a lot of outperformance to wipe away this underperformance. And this is why our investment committee is saying it's time to take a look at other more appropriate replacement candidates, but not today. So does that help? Yeah.
Vincent, just going back to, can you remind us what the forfeiture account was for?
So, and I'll defer to staff, but essentially, it's where participants leave the county before they're vested, and so it's held in the forfeiture.
Got it.
Is that all? I'm looking to see if that's,
Basically, uninvested funds that go back to the county.
correct. And then the county can either use it to offset future county contributions for plan-related expenses or return it to participants.
And going back to that international fund, when you spoke to the manager, I'm assuming they haven't convinced you completely yet. They're not saying, hey, as of right now, we couldn't find any investments, so we're parking our money over here temporarily till we find some better international investments. Is that what you heard from them, or is that what they're saying?
Close, that they're committed to their philosophy, but their value philosophy is now over-allocating to growth sectors. And again, we're not, we would give them somewhat of a free pass if that was bearing out in the performance. But they're getting the style wrong and they're underperforming with no real path to get back to what we hired them for. Or when participants see the menu, they see an international growth as well as an international value. And so both of those are looking very, very similar, except one's performing a lot better than the other. Yeah. Okay, and then back to page 29, sorry, the section to page 29. This is where I was talking about the DFA Real Estate Fund. Remember, this fund was added on January 10th, and so you can see, in essence, for the quarter, the fund was up 2.35% versus the index of 1.17. The premium was 1.18%, 34th percentile. It's the 5-year number that's dragging, and this is where, as I said, somewhat uncomfortable from a consultant standpoint to recommend a fund. You added it, and now it's on watch. But as I said, the near-term performance is good, and talking to the DFA, no real long-term concerns, and so our recommendation is to place that fund on watch. And then last but not least, this is just anecdotal, that Invesco Golden Special Mineral. When there's a safe haven, a lot of the commodities do very, very well. Take a look at that last fund on the menu. For the 1 year, up almost 41%, but the index was up 44%, and then for the quarter, up 27%. So that fund and those participants did pretty well over the short term. Just calling that out. Taking a look at the next section, One thing we do is monitor the fees and then report them, but we do this on a much more regular basis and take a look at any fee savings. On page 30, this is the 457, and you can see each column is broken up into three colors, if you will. The light blue is the investment cost. This is the cost that participants pay the fund managers to invest in the funds on the menu. The navy blue portion is the administrative fee, in essence, what the committee/county can use for plan-related expenses. And then the orange portion is the revenue requirement that Nationwide needs to administer the plan. Staff a call center, send out statements, et cetera. And so you can see the investment cost went from 37 basis points in 2020 down to 33.4. With the move to the lower cost target date funds, those will continue to decrease. You can see the 3.5 basis point remain generally the same. It's the orange portion that dropped as a result of a new contract. You can see 2.25 basis points. We round up to 2.3 basis points. But all in, the administrative cost is 5.75 basis points. But hold on to that thought, because I do want to call out on pages 31 and 32, the expense at the fund level. The expenses here are different than a lot of our expenses because the fund manager simply deducts her or his fee out of the gross return before reporting your performance net of their fee. And so in a way, it's somewhat hidden, but we monitor it because it is a fiduciary responsibility to make sure fees are reasonable. You can see on the left-hand column, like other sections in the report, are all the funds in the 457, but it's the second to right-hand column where all the expenses are articulated. And then towards the middle of page 32, the fees do add up. On a $565 million plan, the fees are only 1/3%, but you can see the dollar value, if we annualize it, is just under $2 million a year. And then the accounting in the next section on page 32 of that 5.75 basis points, again, Nationwide collects 2.25. That is about $127,000 a year. And then the administrative tack-on fee for plan-related expenses of 3.5 basis points is just under $200,000 a year. So those are the fees in the 457. And so to better serve you as a committee and the chair on taking a look at really what these expenses are, where they come from, but maybe where they're going, I'm gonna skip the 401A fee, just in the interest of time and repetitiveness, but end on page 36. And so what we started to do is quarter in and quarter out, almost like an old school bank ledger. We start with the beginning balance, any contributions, any growth, and any distributions. And so you, as a body, know to the dollar what is in this administrative account, back to my point that you can use for plan-related expenses. You can see with the contributions or that tack-on fee, this account has grown to just under $300,000. Now, the IRS, for good or ill, has very little guidance in terms of what you can do for it, other than saying, as long as it benefits participants, and you can reasonably say it does, that's a legitimate plan-related expense. And so a lot of times it's used for consulting, legal, staff, food at an enrollment party, whatever it is. If you can reasonably say this is benefiting participants, it's a bona fide line item. So questions, comments on that report?
Vincent, just in regards to fees, do you notice that Vanguard funds carry a lower fee than the other funds?
Yeah, so a couple things. The question is, do Vanguard fees typically have lower costs? Yes. In fact, 40 years ago when Jack Bogle formed Vanguard, that was one of the drivers, was low cost. Participants don't necessarily need to be educated because it's not necessarily complicated. Offering them low-cost index products to invest in the bond or stock market is the way to go. And they touted their low fees. So the style in terms of passive investing or index investing just naturally leads to lower cost. But here's the thing, a lot of other firms like BlackRock or State Street or Fidelity are also moving into this low-cost arena. So for 40 years, Vanguard was almost like Xerox or Kleenex or Google, just another name to a verb or a household name to imply low-cost indexing, no longer the case. Vanguard is getting a lot of competition. And so in response, about a month ago, maybe 2 months ago, Vanguard, at least on CNBC, about every 15 minutes, they have commercials about lowering their fees by about $350 million. And so the race is on, maybe to the bottom, but Vanguard stood alone for a while. Other firms kind of matched it, and then now Vanguard is lowering their fees even more. So to answer your question long-windedly, yes, typically Vanguard is the low-cost leader.
With that being said, again, I know we don't have all Vanguard funds in here, but I mean, why not go to the Vanguard route for these other funds?
Sure, we would constantly review the fees and the performance, and where it makes sense, make that recommendation, but we're just not there yet. The fees are one input, but only one input in our calculus on the appropriate of the menu. And so if and when that time comes, we will certainly come to you, but just not, I don't want to say yet, but we're just not there. Yeah.
I'd like to go back if we could, if we're done on the fees part. So a few pages back, you have different graphs in different colors, where if it's an 80-20 split or a 60-40 split, I don't see 100% equities position on there. Is it possible to add that? Would that be a big deal, or would that, let's see if I can find the page.
The navy blue column page?
Page 16.
Thank you.
Let's just use it as a benchmark.
Yes, so like page 16 would be an example, something like that, where we have a 40-60, a 60-40, and then an 80-20. But is there one that we do just 100, would it be a difficulty? Is there a purpose to not adding 100% equity on there?
No. I think the three indexes are just for context, but would it be hard to add that? I don't think so. I can certainly ask our analyst to add that. So on page 16 and then on the 457, page 10.
Yes, just as a comparison, because, okay, if you don't have, what if you went 100% equities, where would you be positioned versus doing these 80-20 splits or a 60-40, 40-60? So I'd appreciate that if that's not a big ask, please.
Yeah.
Me as well. I'm 100% equities, I don't have any. That's it. Not yet.
So then to conclude this agenda item, and I'll defer obviously the chair, but I go back to the recommendation of placing that DFA real estate fund on watch status, just given the longer term performance. As I said, the good news is your participants weren't in it during that period, but nonetheless violates the metrics over that full market cycle, so.
This is Fonse. I'll make a motion to approve the recommendation and the report.
Do I have a second?
I'll second.
All right. I have a motion and a second. All in favor, say aye.
Aye.
Opposed? No. Motion carries unanimously. And then, Vincent, you mentioned the next quarterly meeting bringing forward potential candidates for replacement. We don't have to take an action on that, is that correct? We can just.
Generally, no, especially if it hasn't been agendized, then I would say no. Yeah.
I do have a question. For the administrative fee, I've seen other organizations do this where in order to incentivize people, they buy lunch. And so I don't know if it'd be worth it, nothing immediate, but like a, plan for next year to tackle where we have an investment luncheon, kind of like we do the retirement board does in October, but just do it for lunch, maybe make it like an 11 to 1 o'clock for county employees, say you can go, and then have a catered sandwich, bag of chips, cookie, apple type lunch, and then you sit there and hear from these folks. And so I don't know if that would be something where we could spend the planned funds that would be useful, or what you thought about that, but just wanted to float that idea.
I'll take it a step further, give every new employee $5, and then it would be 100% participation. Again, that was just what I was looking at before. I was just kidding about that too, by the way.
Oh, that could be a bad idea.
So,
Only if we switch to an opt-out instead of an opt-in policy. We'll give them the $5 and then there'll be the first $5 invested in the fund. We have to switch to an opt-out instead of opt-in. We're not there yet.
Yeah.
so actually, those are things that we would have to bargain, even giving employees money, we have to bargain. So, but it is one of the things that's on the agenda for the HRLR team to look at some of our upcoming groups as far as trying to encourage participation, and the auto enrollment piece is one of those things that we do have to bargain. But I like the way the committee's thinking.
Yeah.
We wanna
And-
encourage
And just so you
participation.
know, employees, that's the number one question they ask. Is there a match? Is there a match?
The first $5, 100%, the first $5, get your stats up.
Yeah.
All right, I think next on our agenda is to review the investment policy.
Right.
Just
Thank you. So another item in your materials is the IPS, or investment policy statement. Essentially, this is the roadmap that we as the consultant and you as fiduciaries follow in the selection, the monitoring, the watch, the termination or replacement of the investments. One of the key tenets of fiduciary law in California is around not so much the outcome, but it's about the process. And so even though the IPS is not required, it does go a long way to say that you are on top of the fiduciary process or represent best practice. The other part of it is, I've also seen stale IPSs. In other words, where we're engaged and I ask if they have an IPS and they say, yep, and then you look and it's dated 1993. And so it's nice to refresh this and make this contemporary. So every year we agendize this. Given a change on the menu here recently, we do have a change in addition to the cover and page 2 of the dates. But on page 8, as I said, that International Index Fund was added in July of 2024. And so towards the middle of page 8, you can see we added not only the benchmark, but also the peer group for that new fund, and just to make this policy contemporary. And then on page 12, you can see more of a housekeeping, just updated the history of updates for the investment policy statement. So those are the only changes that we're proposing this year. We have a strong feeling that this is your document. Our job is to edit this and propose it. Your job is to have an opinion on any other changes or enhancements or that sort of thing.
I would just probably recommend removing in purpose the last sentence there. Again, you already have when the document was updated on the front page. I don't think you should say as stated in last updated in July. And I'd probably remove that section also, section 14. 175 years from now, this document will be 50 pages if we continue this method regarding the history. Those would be my recommendations.
I don't know how much history has to be there, but there definitely has to be history. And at some point, will have to be shrunk to make sense. But there needs to be some type of, somewhere there has to be history of when the document's been updated. And I believe that's just part of the rules, not something I dreamed up. Just did a lot of policies. I do have a question, though. I believe at the last meeting, the guaranteed, in-plan guaranteed product was approved. Is that going to be added to this, or is it already in here, covered under something else, and I just didn't recognize it? Because there's all these different options, but I didn't see anything that I thought referred to that.
Sure. So the investment solution on that retirement income builder is the target date funds. And so they are included
Okay.
in terms of that investment
Okay.
Vehicle, yeah.
Thank you. I
Yeah,
just, like I
great.
said, I wasn't sure where it belonged, so I thought I'd ask.
Great point out.
right, any other questions or comments? Motion to approve as recommended or as noted by Fonse?
I have no preference either way. But again, like I said, I understand what you're saying regarding the history, but we're not writing anything in the history. We're not saying the adjustments made in 2023, here's a sentence of what we did. All we're saying is, hey, we made some adjustments that year. I don't know how important that would be, but if you wanted to see what happened that year, you could pull up that investment policy for that year and kind of see the changes, I guess. So again, kind of like what I'm saying is, I'm assuming every single year, not every single year, but most of the years, we're gonna have some sort of adjustment. This list is just gonna get longer and longer. Is it beneficial, I guess, is what I'm saying. 10 years from now, we have 2 pages of history. But to get this item moving along, I'll go ahead and make a recommendation to approve it.
I'll second that recommendation.
All right, we have a motion and a second. All in favor, say aye.
Aye.
Opposed? Thanks for that lively discussion, Fonse.
Jennifer, can somebody check to see what the rules are about the history? Because if it's not necessary, then you'll like to know that for all your policies that you're doing this to. But if it is necessary, it's good to know.
Yeah, we certainly can research that.
Yeah. so-
Thank you. All right, next on the agenda, just for everyone's information, later this year, we will be holding an election. So the terms for Ms. Herman and Steve Hopkins as our alternate are coming to an end, so we'll be holding an election for that. Human Resources actually conducts that election. So it starts off in August, and in December is when we will have our newly elected or continuing rep and alternative. Any questions about that?
Is that a retirement designated position or general?
It's just participant. It's not defined as having to be active or retired. All right, if there's no questions then, the next item on the agenda is a discussion about our August 28th, 2025 scheduled meeting. I will be at a conference, and as is our Assistant Director of HR. And so wanted to discuss with the committee if we should be considering rescheduling that meeting so that the meeting can continue. One of the issues and something that the HR team will be working on this year is we do not have well-defined bylaws or administrative guidance that support how we approach these things when the chair isn't present. And likewise, how, if we have any kind of backup. So we don't currently, from my understanding, have a vice chair that could take over chairing the meeting. And so wanted to discuss the potential of our vendors and our committee, if they would be available on August 21st, the week prior to that. Or if there was any other kind of suggestions on handling that.
I'm open for either. If it's more convenient to reschedule, that's totally fine with me. I'm not tied to either date.
Okay.
I'm open to my calendar is available that day.
I'm sorry, Fonse, I missed that.
I'm good.
I'm also available on the 21st.
For our investment team, how much notice is generally needed to plan? I don't know how far out their calendars go.
We have conflicts, I'm sorry. I'm out of town and we have another meeting that day.
Okay.
Yeah, I'm out of the state.
Maybe we should just circle back with the poll or something. And
Yeah.
then kind of throw some dates out for everybody.
All right, we can do that. So after this meeting, then, we won't take any action at this point on this item, and we will have staff reach out to everybody and see if we can find another date that will work. we were kind of hoping to keep something around that same date, and when this room was available, and on a Thursday, but we can, obviously, if we're rescheduling it, we can reschedule it, maybe a little bit more flexibility, so. I was hoping the planets aligned and everybody would be available. Type of thing that I would have not participated, but our Assistant Director in HR participated in the California County HR Association HR Directors Institute, and so she'll be going through a graduation ceremony at that conference, so we wanted to be able to support her and attend that, so. All right, any comments from committee members?
I know you guys always get complaints, but I just want to say the app is awesome. I think it's by far more superior than what we had before. So again, I just want to say, let you know that it's working very well.
I know for the sheriff's office perspective, we've always been really happy with the response we get. If I have questions, I can call our cell phone and people can walk in the other room and get signed up, and that's happened before. So I appreciate the responsiveness.
Are we considering a bylaw change to maybe add a vice chair?
Yes, absolutely. So what we found, and kind of doing a little bit of research, is that as the county moved to different record keepers, some of the, kind of the detail about the committee makeup and some of these kind of procedural things were lost in the plan documents. So we will be working on some bylaws to kind of address some of those issues, and any other things that we've, Hyas can certainly help us with that a little bit and tell us what else we should be considering in there, other than just the makeup of the committee, the regular meetings and those types of things, so that we can ensure it moves forward.
I would recommend the auditor controller be the vice chair if you pick someone.
Just because he's not here today, or? Well, we certainly will be bringing those to you all to approve, so you'll have an opportunity. Thank you. All right. Anything else? All right, then we can, the stated next meeting is Thursday, the 28th, although we know likely won't be happening. We'll make sure we do the appropriate notice on that. And so at this point, I will call the Deferred Comp Advisory Committee to close. Thank you.
Thank you.